Welcome to This Week in Money. I'm Jim Goddard. Today, Ross Clark from chartsandmarkets.com runs down the major markets. They had a poor July, but picked up the last 2 weeks. Ross checks out crude, the U.S. and Canadian dollars, and uranium. Publisher of VRTrader.com, Mark Leibovit, comments on whether the marijuana space is about to spark up again and what stage of trading cryptocurrencies appear to be in. He also talks about the influence the moon can have on trading. Founder of the TrendLetter.com, Martin Straith, weighs in on poor job and economic growth reports, possible interest rate cuts, and the future of oil investments. And for our listeners this Labor Day long weekend, all three of our guests have special offers for you. Check out their websites. We'll talk to Ross Clark right after this.
Recyclico, making lithium-ion last forever. Recyclico's patented recycling process achieves up to 100% recovery of battery metals from lithium-ion batteries for electric vehicles, including cobalt, lithium, nickel, manganese, and aluminum. Recyclico Battery Materials Incorporated trades on the TSX Venture AMY, on the OTCQB AMYZF, and Frankfurt ID4. For more information, visit recyclico.com or phone us at 778-574-4444. Recyclico, making lithium-ion last forever.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark from chartsandmarkets.com, where you'll find insightful market commentary and timely technical analysis. You can find him on Twitter at ChartsByRoss. Welcome back to This Week in Money.
Always a pleasure, Jim.
Ross, do we have a special offer for our listeners this week?
Yeah, we do. It's Labor Day here and in the States, so it's time to give everybody 25% off. They want to put out take us for a trial run. That'll be a 1-year subscription. And, we are coming to that point in the year where you usually get some pretty good opportunities. We recently got some very strong buy signals 2 weeks ago in the markets, and we would hope that we'll get some continuation patterns that give us more opportunities.
Ross, so how did our stock market work out this week?
Well, here we go. We got 2 good weeks in a row after a pretty poor July, and this is to say most indices, S&P, the Dow, NASDAQ, all had corrected to their 20-week moving averages. And when you look at the long-term moves, when you are in the upward trend, that 20-week invariably would get tested, and it came into play just so nicely here 2 weeks ago. Had some great individual buy signals, things like Tesla and Apple, just right down into what we call a capitulation. But this is the style of capitulation where you're in an uptrend and you get a hard oversold condition. Unlike, most people would think of a capitulation as something that's, been down and dirty for an extended period of time. We have signals for that, but the ones that happen when you're in an uptrend have a really good probability of reversals, and they become great trades for option players. The Apple options, anybody who took the trade buying the Apple stock or doing the options, September calls have gone from under $2 to over $10 in this span of 2 weeks. Stock's getting a little overdone right here. Same thing with Tesla. A great run on that one, both on the stocks and on the option. The calls there had as good a run as I think as we saw in the Apple, and got a little overdone. Now retraced over 60% of the decline that we had during July, sort of the end of June into July. So this was a good spot to take some money off the table. As I say, we would hope that during the next month or so here, seasonal lows come into play, and you want to look and see either which stocks are getting hit and down and dirty enough to make them a decent buy, or the ones that are holding up on a relative basis. And, there were a number during that last month and a half that didn't really give up a lot and have popped themselves into new highs. So you want to look for that type of thing. And I think we'll find a few as we move along.
What's happening with the U.S. and Canadian dollars?
Well, U.S. dollars had a bit of a swing. A week ago, we were up into what looked like it might become an interim high over 104. It corrected really hard for 2 days. And at the end of the week, we are right back at resistance. And so this has got, even more buoyancy than we thought it would. I was thinking that we might have a decent little correction into September. And, from the middle of September, you get a cycle low. And from there, would have been ready for the next big run. So maybe what we've got here is a little bit of a consolidation leading up to that low. But it's not wanting to give up much room. And as far as the Canadian dollar is concerned, the move there pretty much in inverse of what you've seen in the U.S. dollar. We had a decent rally up to 74, and it's given back all of its gains as the U.S. dollar picked up here on Friday, and we've got the dollar right down to 73.5. This is just not looking good, and especially when you look at what's going on in the energy complex. I mean, my gosh, we've got oil starting to come not only in an uptrend, but having lots of life on the upside this week. So Canada, not a good-looking market, and that's the easiest path on this one is to the downside.
What's happening in the energy patch?
Well, as I say, on the crude oil, that has just been a nice uptrend since putting in that bear market bottom that, we bottomed out in March, double bottomed April, triple bottomed by the time we were into June, and then you got that nice reversal through resistance in July. The correction that we saw in the last couple of weeks took us from 85 back down under 80, tested some really nice support levels, and only gave back about 30-35% of the advance off the bottom. So nice looking bottom. And this week it was day by day just stepping its way up. I mean, 80 on one day, then 83, 84, and it closed off the week at 85.5. This is now in the process of taking out the resistance levels from the April top and from the one back in January. So we're looking at best levels of the year. Momentum is really good here. The stocks, if you take a look at the XEG, the Canadian ETF, that is trading up at new highs for the year and testing the levels we saw in October of last year. The same type of action over on the U.S. side, the XLE trading at over 90 on that index. So this, both of these have been in, if you take a look at the bigger picture, consolidations that last back into the second or third quarter of 2022. And if they start to break out through here, there's lots of room on the upside. So clearly, it's a sector that was really an performer in the first half of this year, but looks like the second half has got legs in it.
What do we have cooking in the anything else file this week?
Well, the one, we've been looking and we've liked for a number of years has been uraniums, in particular Cameco, which had just a great 5-year base and accumulation pattern. got to remember, we go back to the Fukushima incident, which was now well over 10, 15 years ago. That one had everyone going negative on uraniums and uranium companies. But that was a great base that we saw and identified back in 2022 as it started to break out. And, the implication was from the size of that base that we would have a long extended run. So it's really doing that. This last few months, Cameco has gone from, in terms of U.S. dollars, from $24 up to just shy of 38. Pretty significant run. And we finally, as of the end of this week, starting to see signs that it might be getting a little overdone and ready for a correction. The weekly and monthly charts are definitely overbought. They've got some of our signals that we look for as you're finding interim highs. The daily chart, we've got targets that we measure up to at around $42. Typically, you would find the top of a run like this one with a good spike at the end of it. So if it tacks on, a nice little run in this next week or two towards that $42 level, at that point you could look for a minor top in a correction. And, we've got levels that we're looking for as far as that's concerned. Another reason that we're probably setting up for a turn is that the juniors have really, really had a good stretch here in the last 2.5, 3 weeks. And if you look back, by the time the juniors start to participate, and it doesn't matter what the complex is, whether it's precious metals or the artificial intelligence or whatever it is out there, once the junior names start to participate and everybody's hot and bothered on them, that you're getting to the tail end of at least that run. And that's exactly what we're seeing right now on the small names. And I look back to the 2002 to 2008 rally, and there were some fabulous moves in those juniors back then, but they corrected along the way. And I would suspect that you'll see the same type of thing here. And getting overbought now. But I think, keep an eye on these things. Put them on the back burner, because once you see decent corrections, and I would say that 50-day moving average on those juniors is something you might want to look at. And we've got other levels for Cameco to be looking for, and that will be in our reports that we put out in the next, we put one out this weekend, but we'll have more as hopefully we get a correction that people can look at picking up some better price stock.
Ross, thank you so much for the update.
Good to be with you, Jim.
My guest has been Ross Clark from chartsandmarkets.com. Find him on Twitter at ChartsByRoss. Coming up, Mark Leibovit, next on This Week in Money.
Always consult your investment professional before making any investment decision. Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back. My guest is Mark Leibovit, editor and publisher of the Leibovit VR newsletters, also known as VRTrader.com. He's speaking to us from Arizona. Welcome back to This Week in Money.
Glad to be back, Jim. Thanks for having me.
Mark, do we have a special offer for our listeners?
Okay, we'll do it again for those who want to sign up at VRTrader.com. And we have several newsletters there, including the cannabis letter, which may be coming back into 4 now since we set some action this past week. But we have our metals resource letter, our market timing letter, and we even have a blockchain letter for the crypto traders out there. Anyway, VRTrader.com is a promo code 2022 half off, just as it sounds, 2022 half off on lowercase, and you get 50% off of any of the newsletters for whatever time frame you selected. And I'd like to also disclose that I'm not a financial advisor, nor do I provide financial advice, but produce this educational newsletter and have since, it's unbelievable amount of time, since 1979.
Well, Mark, you mentioned something going on with your cannabis letter. What's happening with, as they used to call it, wacky tobacco?
Yeah, well, the cannabis stocks are in the cellar. They pretty much, many almost went to zero. The biggest name in the last decade was Canopy Growth, which is the Canadian company. It went public under the name Weed. And I remember we bought some down there at $1 a share. I think this is 2014, 2015. Anyway, it went to $58. Now it's trading like 50 cents. And it's had some big swings, and apparently the company was mismanaged. The leader of the company, the guy who ran the deal, was kicked out a few years ago. Constellation Brands, the big purveyor of Corona beer, multi-billion-dollar company, came in. And again, this is about 4 years ago or so, and maybe 5 years, and invested, I think, over $1 billion, or maybe more than that, in Canopy Growth, and it was the hottest name out there. I mean, it was really wild. So apparently they lost their money in that investment, even though Constellation Brands is still doing well in the beer business and liquor business. But Canopy Growth, struggled, and who knows if it'll continue to exist. That's sort of a side story. So this past week, there's been some push for the DEA to reschedule marijuana, from the Schedule 1 down to Schedule 3, so it's not as onerous in terms of access as it has been now for, who knows how many decades. Some congressmen have been pushing for it. It's all over the news. Some argue that rescheduling marijuana to a lesser negative classification may or may not really help the cannabis business. It's funny, as we're talking right now, I was watching some stocks. One of the biggest names this past week was Tilray, which I don't know if you know the story about Tilray, but the stock is another one of the hot names. I'm trying to think of it, 4 or 5 years ago. I mean, it was like, a few bucks a share, and apparently there was a very limited supply of stock in the market. There was a short squeeze, and the thing ran to $300 a share, like in this unbelievable spike. From one day, went up $100, $150 because of a short squeeze. Went all the way back down, and now was trading under $1, and now it's around $3 now. So that's just another side story I'm giving you. That's sort of another hot name in the group. There's a lot of money made and a lot of trading opportunities. Anyway, we like Tilray. My newsletter, we talk about it. Because, there's about a week or two ago, they decided they want to get into the beer business, and they bought from Anheuser-Busch some assets, some breweries, and I guess a form of diversification. I'm hearing the president of Tilray on the network television the other day, saying, hey, we're sort of tired of waiting for the government to deregulate marijuana, so we got to diversify our company. So they bought some beer assets from Anheuser-Busch. The stock popped a little bit, and then this past week the DEA came out, the story about the DEA came out about rescheduling, and the thing ran from $2 to like $3.15, but like 100 million shares a day. So it's a great trading opportunity, and really I'm talking about all this. Is it possible that the cannabis stocks, which have been in a bear market the last couple of years, suddenly turn around here, assuming that deregulation occurs? And as I mentioned a moment ago, I'm not an expert on the implications of it, though there's some conflicting opinions about how the deregulation will help business for Tilray or Canopy Growth or dozens of other big names that are in that space. But it's a step in the right direction, I think. And I know when you talk to the leaders of these companies, they say, how can we do anything in the United States if it's even the Canadian companies like Tilray or Canopy Growth, if it's not legal as it is in Canada. So it's got to be at least one step in the right direction. So that was sort of the hot story this week, and we were pretty active following this Tilray because you can buy a dollar stock that doubles or triples and trades 100 million shares a day. For traders, it's sort of a dream, if you pull 50 cents out of it with the kind of volume it's been trading. So sort of hot name out there now that the company's diversified. And, I'm not promoting Tilray. I'm just telling you this is a vehicle that if you want to get, if you're looking at the marijuana space, they've diversified a little bit, and there's other names out there, and maybe the bear market finally is coming to an end. And, it all depends, of course, how much demand there is for marijuana, and, whether it's as strong as people thought it would be, even with deregulation here in the U.S. So there are a lot of variables on the table. I know a lot of the U.S.-based cannabis companies stand to benefit quite a bit because many of those were making money even before this deregulation issue came up. So it's just interesting stuff here, a little action this week, and just thought I'd bring it to you, the viewers' and listeners' attention.
Germany is allowing recreational marijuana sales, first European nation to allow that. Is that because they're in recession and they need the revenue?
Well, this goes back to the reason why lottery was created decades ago. The state governments needed an extra source of income, so the lottery got approved really quickly. And then when Colorado was the first to legalize marijuana in the state of Colorado and legalize the dispensaries, the income, the tax revenue was fantastic, and it helped really the state of Colorado quite a bit, and other states start to catch on to that too, so it starts spreading from Colorado. So, your comment about Germany makes a lot of sense. Yes, it's definitely, you don't have a printing press and you can't print money like the federal government or the EU, so, if you're an individual country or company or county or state and you want to generate extra cash, legalize it and you'll generate a little more, tax revenue. So I think, yes, that's pretty much part and parcel to the whole thing. But, for a couple of years, there was a lot of push that, had medical benefits and you really need to have access to it. And it just was a boom and bust situation. It just, a lot of overinvestment, a lot of speculation. The business sort of dried up, and it'll be interesting to see, if it really will turn around both in Canada or here in the U.S. or Germany or other places that, a lot of money was put into this thing. I mean, I attended a lot of conferences. I was one of the first out there, by the way, I got to give myself some credit here because I was accredited many times that I was one of the first out there even talking about this. This was 2014, I think, and I was at a conference in Vancouver, in fact, and I promoted marijuana stocks, and this is when weed was just going public at $1 a share. Ultimately, it got renamed to Canopy Growth, which was the blue chip name. But the audience was laughing when I brought it up because they couldn't believe that an analyst or a commentator would talk about marijuana or marijuana stocks. And actually, that was the bottom, and from there, these things went up hundreds or thousands of percent, and you had a boom there for a few years. So I give myself some credit for seeing that, and I saw it because I saw all this volume, and that's part of what I do, the volume reversal in my technical work. I saw all this volume coming into these stocks, and from my floor trading experiences, that told me there were more buyers than sellers, so I had no idea how far it was going, but it looked to me that there might be a play here. So to answer your question about Germany and other, areas, countries, states here in the U.S., provinces in Canada, yes, definitely it's a source of revenue.
Now, Canada legalized marijuana for recreational use in October 2018. Friends of mine in England said, what, it must be a riot there, mayhem in the streets. I said the day afterwards was exactly the same as the day before. The people who used it now could just get it legally and not get a criminal record. Also, a country or a state or a province, you're saving money here, folks, because you're now not having to send people to very expensive jails for consuming a plant. But there's also the black market has been hurting these companies too. I mean, all the reports that I read is they
that
sell cheaper.
Part of the reason they haven't been doing as well. Many of these dispensaries and so forth is because you walk out the door and somebody can sell it to you privately and apparently illegally as well, but save you quite a bit of money. So that was hurting the official companies and outlets out there because of the black market. And the question is that going to change? Probably not. There's always a black market for something, right? So it's a very interesting conundrum here about how it's all going to work out. But I like Tilray because the fact they diversified a little bit and got into the beer business and maybe they'll do some more diversification and not only rely on marijuana. Maybe some of the other companies will decide they want to become like Vice, VIC type companies, sell all kinds of vice, sell beer, liquor, maybe get into tobacco as well as marijuana, maybe open a casino somewhere, you know what I mean? Do all the vice, businesses, which is a business opportunity, of course, all of them, and maybe if they get diversified and get into numerous vice-related businesses, maybe that's a way the industry can pull itself out here. And of course, I'm just speculating, but with Tilray making that move into beer, I thought that was an interesting move.
I remember driving from California to Nevada, and there was a sign that said, we have legal sex, we have legal 24-hour booze, we have legal gambling, don't even think about drugs.
Right. Oh, that's a good point. Yeah, well, the whole idea of marijuana and CBD and so forth was that these were alternate healing opportunities away from prescription drugs and so forth. And there's all this anecdotal research out there about how marijuana, and whether you have the THC component, which is the hallucinogenic component, in it or not, or just go with the CBD plant and the drops and the pills, helping everything from sleep to claims of cancer cures, so a lot of alternate stuff. And when you think about it, marijuana has been around thousands of years. It's like talking about the gold market. Why you want to know gold? Because there's a history that it's been there and probably always be there. So this is nothing new. It's not like we suddenly discovered marijuana. I mean, it's been around, again, forever. So it just came out into the public eye and became more acceptable, and there was a push for it. But yeah, there are some stories. I've been to some conferences over the last several years, and a lot of claims about how it helps your health in different ways. So you have to do all the research on your own and check it out. But obviously, the prescription drug companies don't care for it too much unless they could somehow lock it up and sell it themselves, because that takes business away from them. But yeah, I do agree. I know people that have used both the CBD and the marijuana for different ailments, and I've heard nothing but positives about that. So it's definitely worth investigating.
The DEA for 25 years suppressed a report from UCLA that said not only did marijuana not cause lung cancer, it prevented it by sloughing off precancerous cells.
I believe it. Yep. The good stuff doesn't come out. They suppress it. This is, again, we get the whole discussion about prescription drugs and drug companies and the vaccine and all kinds of unbelievable, we'll get tangential discussions here, but I'm not a big favorite of the drug companies, because, ever since the FDA allowed them to run commercials on television, I'm sure you see that on your TV as well, singing and dancing and jumping around and music, and buy this drug, and by the way, in the next 50 seconds telling you about how it could kill you, but in the meantime, it's a happy, well-staged, produced commercial about how you should buy a drug. When I saw that happening, I knew it was all a bunch of nonsense, because most of the drug side effects, unfortunately, could be very severe and negative. But when you take CBD or marijuana, there isn't that kind of side effect. Yeah, maybe you won't get up right away. You'll be a little dizzy, or you'll go to sleep, or if you take too much of it, it might knock you out a little bit. But it doesn't have the effects or potential side effects of prescription drugs. So obviously, I'm not a big fan of the drug companies. So that's a sideline. But meanwhile, I am a proponent. Using your own discretion, and using marijuana, CBD as you see fit, because of, again, anecdotal and other evidence saying that there is a benefit, and the fact it's been around thousands of years versus these prescription drugs, which for the most part are just all relatively new in the last several decades.
And of course, don't get me going on online gambling now, since the U.S. Supreme Court said you can gamble on single game results and all the props that go with it. We have celebrities like Wayne Gretzky, who, even if you're not a hockey fan, you know who he is, saying, hey, bet with this company. Ontario is going to pass a law saying celebrities and sports figures can't promote online gambling. 4.6% of the population is addicted to gambling, according to the government, but they account for over a third of government revenues from gaming.
Well, what about the traders out there like myself who are addicted to the stock market, right? There's different forms of gambling. If you're a trader, as me, I consider that an addiction on a certain level, but I'm having a lot of fun and making money doing it. So I guess if I was good at the crap tables, I'd be doing that all day instead.
Yeah, but like VR trader, you've got some statistics and trends to follow. Gambling is pure chance.
Yeah, I guess you're right.
Yeah.
There is some luck associated with any investment, whether it's stocks or gambling. But yeah, I agree. Yeah, there's more chance there because this is more an intelligent approach. You're using charts. You're looking at the news story, and you're weighing your risk reward on these trades. So this is what's going back to a few minutes to my marijuana story. Yeah, when I saw technical signs that big buyers were coming into some of these marijuana stocks, that told me he was heading up and going higher. So, yep, you can definitely reduce your risk factor if you do some analysis.
Now, what do you think is going on with our lunar cycles? We had a super blue moon. The moon was at its closest as it's going to be in about 4 years. And we had 2 full moons in 1 month, which is called the blue moon. And combine that with a hurricane, you get higher storm surges, don't you?
Right. That's what that's all the meteorologists are reporting. There was a side effect to the supermoon that we saw a couple of days ago that accentuated Idalia, the hurricane that hit Florida and is now floating around out there in Bermuda somewhere and still hasn't died off completely. But yeah, the storm surges, and it makes sense because the moon was relatively closer to the Earth than it had been, and of course the moon has its effect on the tides anyway. And, I track the moon for cyclical reasons and have for many decades, and I've told that story many times. So, yeah, it makes a lot of sense. And, I always look to see, when there's new moons and full moons around anyway, just from a cyclical point of view. And commodity traders have been following this kind of stuff forever. So, when I saw this full moon here with the supermoon, I said, gee, the stock market's going up. Maybe we're going to peak out here a little bit right into the full moon, a form of quote unquote lunacy, because we know that emergency rooms get busy during full moon. So, sometimes you get exaggerated effects on human beings, investments, hurricanes, all kinds of neat stuff around these lunar events. So it's something worth paying attention to. And certainly with regard to this Italia and the tide situation, the meteorologists were definitely noting that. So the moon's there. It's not there just to look pretty in the sky. Its effects on the planet are significant, and since our human bodies are mostly contain water, you don't think the gravitational pull of the moon, as it does for the tides, affects humans? Of course it does.
Yeah, I know. So often they'll say the statistics at the hospital don't record more people during full moons, but I talk to paramedics and cops all the time, and they're saying, well, for some reason, we're a lot busier.
This has been a story forever. This is nothing
well,
new.
Also, people go, even before the days of electricity, a full moon meant you could go out at night. There was light. So, yeah you're going to get into more trouble.
That's a good point. Absolutely, yeah.
What's going on with cryptocurrencies right now?
Well, we had a little bit of a pullback. The whole group had a little bit of a setback this past week. A little bit of a speculative fervor. Took these things a lot higher. Bitcoin in particular. This is only going back about a week ago. It hit a new relative high around $21 on the GBTC, which is the ETF. And as I mentioned, BlackRock, Larry Fink, I think they're the biggest fund on the planet. Several $1 trillion of investment are trying to launch a ETF, and I'm pretty sure it'll happen at some point. But apparently that somehow got delayed, and Bitcoin backed off here a little bit. So we're just getting, a technical retracement, and many of them, start to sell off a little bit. So I think, hesitation. Also, the SEC is sort of challenging that court ruling that went in the favor of Ripple the company Ripple, that is the creator of the XRP crypto. And not to say the challenge will go anywhere, but that put a little dent in the party there a little bit. So XRP backed off along with Bitcoin, and I guess it's all related to regulators. What the SEC is going to do with regard to the Larry Fink ETF Bitcoin project, and what the SEC is going to do or can't do with regard to the Ripple court case. But nothing more than an expected, technical correction in a very volatile market. You cannot be in XRP or Bitcoin or Ethereum and not expect huge swings. That's just the nature of the beast, and that's why you should be in it, because you can profit from it in both directions, long or short. I mean, if you got an ETF for Bitcoin and BlackRock is successful in launching it, you could short the damn thing and, carry and make some money on the downside and go long again. And, you don't have to deal in the actual Bitcoin itself. You can do it as a stock, which obviously is a lot easier for most people. But one thing I will point out, which is just called a common sense, is if they do, and I'm sure it'll get approved because of just of the nature of who BlackRock is and Larry Fink and their influence in the industry. But once it does get approved, it'll probably drive Bitcoin a lot higher, just as GLD, which is the ETF for gold, was a big part and parcel to gold moving higher after it was formed. So it's just something to watch and trade. And I'm a bull on the whole sector, including Bitcoin, but you have to have either trade it all the time or have a 2-3 year type of perspective,
What's going on with the U.S. dollar? It seems like the BRICS, they added Saudi Arabia and the United Arab Emirates to their consortium. And isn't it just an all-out war on the U.S. dollar now?
Well, it's holding up pretty well. It pulled back for a couple of days. We actually put out a report on the euro and the ETF for euro. It looked like we were going to get a nice little bounce there, and it did bounce for a couple of days as the dollar pulled back and the dollar rallied again. Overall, it still appears the rally is intact in the dollar. I mean, it's pretty much been, in an uptrend, at least, in terms of the short term since July. And, looking at it, going back, several months or so. I mean, basically we had a big move since September of 2022 in the dollar. Then it went to a little bit of a correction here at the beginning of this year, and been going sideways since, but seemed to have a little bit of an upward bias to it, which the precious metals people don't like, gold in particular, since they trade inversely. But it seems like the dollar is hanging in there, and is that because BRICS was unsuccessful? I mean, in really creating the change that they're talking about, which is probably the case. I think the dollar is more resilient than people realize. It's not going the way of the dodo so quickly. And, the BRICS is a very interesting situation because they added several more members. So, and then I hear there's about 20 more countries applying to become members of it, which could represent, from what I understand, 80 or 90% of the world economy. So are they going to create a new currency? Are they going to back it with gold? I think it's a lot of talk right now. I mean, maybe in enough time it'll all happen. So it'll be interesting how it plays out. But you have some serious adversaries there. I mean, Russia and China have been hoarding gold, and they want to do business away from the dollar. So and if the world is really against the dollar and it's going to represent potentially 80% of the world economy, I guess at some point the dollar could collapse. We saw it happen with the British pound. We've seen it with other currencies, others going to zero, particularly in Africa. So anything could happen. So you got to be aware of that risk. But if you're trading only in the U.S. and you're only dealing in U.S. dollars, it may not affect you as much unless you're involved in other markets, like the commodity markets, which are priced in dollars and they go up and down quite a bit and stuff like that, in gold. But if you're just staying within your own country and trading your own currency, the demise of the dollar, I don't think it's going to make a lot of difference to you other than the cost of goods and services, which obviously could change because of international pricing. But I don't think your life's going to change overnight, that suddenly the dollar is less significant than it used to be. So, but, we do have a deteriorating economy here in the U.S. with printing of money, and since the Federal Reserve came in, we've talked about this quite a bit, how the value of the dollar's, dropped in the last 100 years since the Federal Reserve got its hooks into the printing of money and so forth, and managing recessions and depressions. So it's really up in the air how it all goes. But right here, the dollar seems to be hanging in there, and I'm surprised. I thought it would have a big sell-off with this BRICS conference, but the BRICS was a little bit of a disappointment for the gold bulls, Jim, because there was all this hope and discussion that they were going to create this new currency and tie gold to it, and that would be the end, but a lot of talk and no action.
Well, on one hand, they added Saudi Arabia and the EU to that, and to the BRICS group. They have a lot of cash, but the Chinese currency and the Russian currencies are in the dumps right now. Really, really low. So, yeah, what kind of power do they have to take on the U.S. dollar, which has been supreme since the Second World War?
Right. That's it. It's the expression last standing horse in the glue factory? All the currencies seem to go down or go the way of the dodo at some point, because that's history. I mean, we've seen this forever. Dollar probably the last to go, but it could eventually go, and the question is what takes it over at that point, So we've been talking about this for a long time, and we do know that, Iran and Russia and China have been doing trading away from the dollar already. So, the question is when it becomes universal. So I'm just looking at the charts here. I mean, what are we doing with our stuff? Are we buying or selling gold? Are we buying or selling the dollar or the euro? Or what are we doing? Are we basing it on price volume, technical action, some news, and everything is all relative? So, as far as my day-to-day existence, looking at charts and trying to find opportunities, whether it's cryptocurrencies, oil, gold, or whatever, you're looking at the action within that particular sector, commodity, stock, and just seeing, are there more buyers and sellers or sellers and buyers, and act accordingly. So I'm not going to worry whether the U.S. dollar is number one or not here. It's as long as you can see in the charts what's moving. Another area that's moving now, you were probably going to ask me anyway, is crude oil, which has taken off here in the last several weeks and got up to about $86 $86 a barrel. It was down in the mid-60s not too long ago, and how I stand, I've been super bull on crude and energy. So the strength in the dollar, which has been underway here recently, has not affected crude oil, because we know historically there's an inverse relationship between the dollar and crude, as it is supposedly with gold and silver, but it has not affected the crude oil market. So that's really interesting what's going on with crude.
And just on the currency thing, if I was at a Turkish bazaar at the Casbah and I had two different bills in my hand, one with a picture of George Washington on it and the other one a picture of Chairman Mao, and said, which one will you take?
Yeah, you're right. They hoard dollars everywhere around the world, correct? $100 bills, I understand.
The Benjamins.
Right.
Mark, thank you so much for being on This Week in Money.
My pleasure, and thanks for having me, and we'll talk to you next week.
My guest has been Mark Leibovit, editor and publisher of the Leibovit VR newsletters, also known as VRTrader.com. He was speaking to us from Arizona. Coming up, Martin Straith, next on This Week in Money.
Recyclico, making lithium-ion last forever. Recyclico's patented recycling process achieves up to 100% recovery of battery metals from lithium-ion batteries for electric vehicles, including cobalt, lithium, nickel, manganese, and aluminum. Recyclico Battery Materials Incorporated trades on the TSX Venture AMY, on the OTCQB AMYZF, and Frankfurt ID4. For more information, visit recyclicode.com or phone us at 778-574-4444. Recyclico, making lithium-ion last forever.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. My guest is Martin Straith, founder of Trend News online at thetrendletter.com. He's speaking to us from Coquitlam, BC, which is just east of Vancouver. Welcome back to This Week in Money.
Oh, thank you, Jim. Good to be back with you.
Martin, earlier this week, we got U.S. jobs data and consumer confidence reports, both negative. So why did the markets rally on that news, or was the rally even connected to that?
Yeah, Jim, we're living in some pretty interesting times here. It's almost like we're living in a parallel universe where good news is bad news and bad news is good news. Yeah, so we had a real mixed bag of data this week. Early in the week, we had the U.S. JOLTS report. So that shows the number of job openings, and it showed it was much lower than anticipated, where the job openings in July fell to the lowest level in 2.5 years, to 8.8 million jobs unfulfilled. Now that's still a pretty high number, certainly compared to the averages over the last decade, but it was really down considerably since the high of over 12 million openings back in March in 2022. Then we had the ADP payroll data show that the number of new jobs was down from expectations. And then we had the U.S. Conference Board publish their Consumer Confidence Index, and it was down 10%. So that was suggesting now that consumers are negative for the economy for the next 6 months. So, I mean, to your question, why did the markets then rally with all this negative news for the economy? And, it really gets back to the same theme. The markets are absolutely fixated on what central banks are going to do. So the central banks want the Fed and the Bank of Canada to pause on rates and then start to cut. So when we get fewer job openings, fewer new jobs, rising unemployment, and lower consumer confidence, that suggests the economy is declining. So, theoretically, that the Fed should then hold off raising rates. So I think that's exactly what we saw early in the week. Investors believing the Fed will pause at their September meeting and then potentially cut rates into 2024. Now, then on Thursday, yesterday, we see the Fed's favorite inflation gauge, so the personal consumption expenditures. So that was showing the inflation was actually up slightly. So the markets cooled off. That justified the Fed's stance that they would need to keep rates higher for longer to fight inflation. But by the end of the day, Thursday, the markets pretty much recovered, so it kind of netted out. Now, here on Friday, we've got the markets opening higher with higher unemployment. And now it's flattened out. I'm just looking here as it's closing. It's the Nasdaq's down, the S&P's up a little bit, but so pretty much sideways to close the week. And again, all this is just showing us is that the markets just remain totally fixated on what the Fed might do. Every data point that comes out, the markets try to peg how will this affect the Fed's decision. So, good news is interpreted as bad and vice versa. So if the market looks like it's slowing and unemployment's rising, the market considers this good, and that means the Fed should back off raising rates. Now, if inflation rises, wages rise, unemployment drops, then that's considered bad because then the Fed has an excuse to keep rates high to battle inflation. In the meantime, what we need to do is watch the charts, keep an eye on the trends, and what we watch is for changes in those trends.
What's your take on the stock markets today?
Well, right now we're bullish. Each week in the trend letter we show, I think I mentioned this the last couple of times, we show the weekly heat map of the S&P 500. And we do it because it's just a great visual of the equity markets that hold the stocks that a lot of North Americans own. There's each of the 500 stocks in that index is represented by a box, and the size of the box represents the market valuation. And then the color of each box tells you how that stock did. So bright green, big winner, dark green, positive, bright red, big loser, dark red, negative. So, I'm looking at the weekly chart right now, and the first thing that sticks out to you is that valuation. So you've got Apple, Microsoft, Google, Amazon, NVIDIA. They all stand out because, they're a huge market capitalization, and they're also all green. So, the big tech stocks ended the week looking, for the week green, although on a daily basis, they were down a bit. So we're currently bullish, but we also keep reminding our subscribers September is historically the worst month of the year. Now, that doesn't mean it can't have a positive month, but we need to be on alert of any changes in trend this coming month. So with the S&P, it just broke through the 4,500 resistance level. So that was a very bullish move. So we need to remain bullish as long as it stays above the recent low around 4,400. And then if we look at the big picture, the S&P 500 is still solidly in a long-term uptrend since 2009. And that's despite, the many bearish and recessionary signals we've been seeing. So there's still a strong momentum in these markets. So as we enter September, we do need to keep on alert that this is the weakest month. And if we were to test the initial support of that long-term uptrend channel since 2009, we would see a correction down to about the 4,000 level, and that would be about an 11% correction. So from the current 4,500. And if we do get a decent correction in September, that can present us with a really nice buying opportunity. So, we've got, the Wall Street big boys, they'll be back after the long weekend. So we're going to see how they react. But, the sectors that have looked good here are, we've got oil, uranium, tech, gold, base materials. Even cannabis with, the announcement of the U.S. Health Department urging the DEA to relax restrictions. So we'll see if, these sectors can remain strong after Labor Day, or if that negative September seasonals take over. Again, our job is to track these key support and resistance levels, looking for changes in trend. And then we alert our subscribers when we do see those trends change.
With the expectation of no more rate hikes, when will the Fed start to cut rates, and will that be a time to load up on stocks?
Yeah, well, that is certainly the common expectation. Like if the Fed starts cutting rates, it's time to back up the truck and load up on stocks. But, here's the thing to seriously think about. If the Fed were to start cutting rates, the question would be, why are they cutting rates? And the reason for the Fed to cut rates will be that something is broken and the economy is suffering. So if the economy enters a soft landing, meaning the economy slows, but it doesn't fall into a recession, then cutting may avoid a recession. But that's walking a really, really tight balancing act. And if they do start to cut too soon, we could easily see inflation ramp up again. And I totally believe that the Fed and the Bank of Canada have made it crystal clear they do not want to see inflation rising again. So if we look at the last number of times that the Fed cut rates, so we're talking back in 2000, 2007, and 2020. Each time that they cut, it was driven by the economy falling into a recession. And when they cut the rates, the S&P 500 had sharp declines. So that kind of makes sense, because if the economy falls into a recession, consumers are going to pull back on spending, companies are going to lay off workers, everyone is worried, and those are not good for business or stocks. And each of those cutting phases, it was not until the Fed stopped cutting rates that the S&P started to recover. And again, that makes perfect sense as well, because the Fed no longer needed to cut because the economy was recovering, and that is good news for business and good news for stocks. So, Jim, I'll post this chart. It's just so telling, and it really helps people. I'm really a visual person. I know our subscribers like to see these visual charts, so I'll post it so your listeners can see. And it's because it's important for investors to see these charts and not get sucked in by the talking head, always telling them to buy all the time. there are good times to buy, and then there are times to hedge.
What about currencies, the U.S. and Canadian dollars? Your thoughts on the euro and yen?
Well, people always ask why we publish charts that include bonds and currencies along with the equities and commodities and precious metals. And, the reason we do that is that these sectors are all connected. And showing these charts allows subscribers to understand these connections. So the U.S. dollar was in a downtrend from late September right up to the middle of Job. Since then, it's been on a really nice rally. Now, it started to tail off early this week, and it's rebounded like yesterday, I think. Now, the reason for the recent strength in the dollar, the U.S. dollar, is that the U.S. interest rates remain higher than other central banks. So, you've got a German bond buyer. I mean, he can get 3.5% for his German one-year bond, but he could get 5.5% for a U.S. 1 year. So central bank actions, it impacts bond yields, currencies, stocks, commodities, precious metals. Again, it's all connected. So now we've got, with weaker job, inflation, and consumer confidence data, the expectation of a Fed pause is starting to gain traction here. Now, if the Fed does pause, the markets are going to focus on the other central banks, so the Bank of Japan, ECB, Bank of Canada, and see what they do. Because if the ECB pauses, then the U.S. yields are still higher, and that's going to continue to attract foreign capital from the euro region into the U.S. dollar. So we show all these connections all the time in the trend letter. Next near-term resistance for the U.S. dollar is 104.2. Near-term support is 102.75. Now, for Canada, Canadian dollar, back to the theme of everything's connected. So when the U.S. dollar is strong, most other currencies will be weaker, and that's been the case for the Canadian dollar since mid-July. Now, this week, we did see the Canadian dollar get a little boost from those higher oil prices. But this morning, we just got the GDP data for Canada, and it shows the economy is shrinking by 0.2% in the second quarter. And that's compared to the Bank of Canada's own estimate of an increase of 1.2%. So this is a huge miss. So, again, back to the bad news is good news theme. Now, this suggests that all these rate hikes and the Bank of Canada rate hikes are now having a much greater effect than the Bank of Canada thought it would. And now that they could pause. And if they do, and the U.S. raises their rate, well, then we could see the Canadian dollar get challenged quite dramatically. So key resistance for the Canadian is 75 cents. Near-term support sits at about 73.25. Now, Europe, we've got Germany, Sweden, and much of the Eurozone is now in a recession. You got inflation dropping. So now the big question is, what does the ECB do regarding rate hikes? Germany's the largest economy in Europe. And if the ECB keeps raising rates, that's going to hurt these countries that are either in a recession or close to falling into one. So the euro had a big sell-off from May 21 to October of 2022. I mean, it lost 23% of its value. Then from that point, it recovered almost 17% of those losses right up to mid-July. Now, since July, the euro struggled mightily against the U.S. dollar. So the main driver has been investors moving capital into the U.S. dollar from Europe, taking advantage of those higher yields. And they believe that the ECB will continue to have lower central bank rates than the Fed. So again, this is all connected. And if you can understand that, it all makes sense. So if you swing it over to the yen, it's a similar story. It's been in a big decline. It went from November of 2020 right through to November of 2022. So 2-year decline, and they lost almost 33%. It then recovered almost 12% before giving most of those gains back since March of this year. I mean, Japan is a mess. It's got the highest debt to GDP in the world at 266%. And you think about that, that's higher than Greece, Sudan, Venezuela, and Lebanon. And they were the next 4 worst ones. So over the last 2 decades of aggressive monetary easing, Japan is still in a deflationary environment. So while other central banks have been aggressively raising their rates to fight inflation, Japan has not. So, the U.S. Fed rate is now 5.5%. Japan's central bank rate is still negative at negative 0.1%. So capital has fled Japan, again, seeking greater yields elsewhere, and that money's gone to the U.S., and that pumps up the U.S. dollar. So there's been a lot of expectation the Bank of Japan is probably going to intervene here because the yen's been clobbered. A weak yen means very much higher energy prices and food prices for imports, and that's crushing Japanese consumers.
British Columbia Premier David Eby sent an open letter to the Bank of Canada saying, whoa, stop with these rate hikes. The average person can't withstand them anymore. It's hurting the economy. It's just hurting everything. Do you think they listen to things like that?
Well, I think it just all comes around, I understand why the central banks are doing what they're doing. But like you say, people are getting crushed here. People are having their mortgage renewed that, they had a 5-year mortgage at, 1.9%, and they're coming in at 6.5%. I mean, my God, people need to live, but it's a vicious cycle. It's a vicious cycle. I'm sure they listen, but I think they're really watching these numbers. I really think that they've been pretty steadfast for the last year and a half that they're not going to let inflation get away from them. And, it's interesting because they are a big part of why inflation is what it is. But, I'm sure they listen, but I think that they really look at their data. But when they see, the GDP drop, 0.02%, when they thought it was going to rise 1.2, I think that's really what's going to open their eyes.
Gold had a good week. What do you see ahead for the precious metals?
Yeah, well, gold, the U.S. dollar has been a big headwind for gold, from the first of the month here. But in the last week, that trend was breaking down, and we saw both gold and the U.S. dollar moving up together. Now, this happens on occasion when we see both gold and the U.S. dollar act as safe havens. But short term, I really expect that the normal trend's going to resume here, and we're either going to see gold up and the U.S. dollar down, or gold down and the U.S. dollar up. Since making that double top at 2070 back in April and May, gold has been unable to break through and close above the $2,000 resistance. When I was last on here, Jim, I think last month, I said that I thought that there should be a good buying opportunity late in August for gold. And so we will see if this current rally can actually push through that $2,000 resistance level, because that's been so strong. So near-term resistance is that 2,000. Then we got 2040. Then we got 2070. And that 2070, that was that double top in April and May. Next support level is at 1915, then 1900, 1880, and then there's really strong support at the 1825 level. And if gold drops to 1825, that will trigger a lot of new buy alerts from our models. So ultimately, I say this all the time, but I truly believe it. Gold will rise as confidence in government collapses, and people realize how these massive stimulus packages and huge deficits are crushing their purchasing power.
You've previously said you expect the U.S. to enter a recession. Have you backed off on that forecast?
Well, as I mentioned earlier, I think it's going to take an incredibly delicate bit of maneuvering by the Fed here to adjust monetary policy that cools the economy but doesn't crush it. And, their history of overdoing almost every Fed policy tells me that they're likely going to continue that trend. The Fed has a budget of over $6 billion, and they have over 400 economists with PhDs. And yet, with all those resources, they tend to get it wrong almost every time. So they are in a really tough spot, but they've also contributed to that tough spot. Just as we were talking about the Bank of Canada, they're in a rough spot. During the COVID lockdowns, the supply chain was shut down. People were laid off. So the Fed decided, and Bank of Canada did the same, they decided to juice the economy. So they added, the Fed added over $5 trillion to their balance sheet, buying up bonds and mortgage-backed securities because they wanted to keep the rates low, help the people out. And then at the very same time, the U.S. government, they pumped another $5 trillion in stimulus packages, handing out free money. And so this combination of $10 trillion of stimulus, that created all this new demand for goods, but the supply chain was still choked. So that dramatically drove up inflation. So then the Fed waited too long to raise rates, saying repeatedly that inflation was transitory. So now back to your question, do I still think it's going to have a recession? Well, I look at history. An inverted yield curve is a leading indicator of a recession. And since 1955, there's been only one time when the yield curve inverted without there being a recession. Recently, it's the most inverted the yield curve's been in over 40 years. Typically, a yield curve inverts 6 to 24 months before a recession. The current yield curve is fully inverted since June 2022. So we're now more than 14 months into this inversion. So that's suggesting we're going to get a recession, and it will likely start in the first half of 2024. Now, the other indicator with a near perfect record of forecasting a recession is the Conference Board's leading economic index. And what that does is it looks at 10 different components across the U.S. economy. And that index, again, the latest report last week, is firmly saying a recession is coming. So now there's always a chance that both of these indicators will be wrong, and hopefully they are. But I think it would be totally foolish for any investor to not at least have a plan if we do get a recession. And, and as investors, we need not forget that the stock market typically tops out before a recession, and it starts and bottoms out before it starts, and it bottoms out before a recession ends. And the other big thing for investors is if we get a recession, recessions they give incredible buying opportunities. So, if we look back at the last 5 recessions, you've got back in 1990, we had a very similar situation as today. You had a tight monetary policy, and they were trying to fight inflation. Well, the stock market crashed, but at the end of that crash, around 1993, we had a stock market rally right up until the Gulf War and the savings and loan recession kick in. Again, markets crashed, but then we had another near 10-year rally to the dot-com bubble, and then again, massive stock market crash. So, I remember the NASDAQ was down 75%, but then we had another really nice rally right up into the financial crisis. Then we had a massive drop again, stock market crashed, and then since 2009, we have been in an uptrend for, 13, 14 years now. So, these recessions, they're horrible for the economy. But as an investor, if it's going to come, you watch these trends, you watch these support and resistance lines, there's going to be some fantastic buying opportunities.
So what would be a good plan for our listeners if we do get a recession? Well, you need to keep track of what's happening in the markets. Don't worry about what all the talking heads or TV are telling you. Watch the trends. That's what we do. We use a lot of charts in our work, and we let our subscribers see for themselves what's happening, what is driving the markets. When a trend breaks, either up or down, that's a signal. So just this week, we saw the S&P 500 break above its 50-day moving average. Well, that was a short-term bullish signal. So if a recession does come, we are going to see trend lines break, and that will trigger sell signals. Stocks historically do not do well in recessions. So, both our trend letter and our technical trader service, we use inverse ETFs to play the short side when we think that the market's going to drop. And these are really easy to trade. It's the same as a stock, just a click of the mouse. Our technical trader
it started as a hedging service because we wanted to create strategies for subscribers to give them tools to protect themselves in declining markets. And so the technical traders have a whole slew of very good strategies that subscribers can pick one or two that they want to use, and they go with it. So right now the markets are bullish, seeing that the economy is slowing, hoping the Fed will pause. But if we do enter a recession, you want to have those hedging strategies ready. Short term, I'm expecting that we will see a rally into year end. And if we do, that's great. But, it will likely be, 2024 where we expect to see those hedging strategies needed. And, all investors should have a plan. If these trends break to the downside, you have a strategy. If they break down in a week, a month, or 6 months, you have to have a plan ready.
Oil's been quite strong. What's your take on oil?
Yeah, oil's had a great week here. After dropping to that $80 level, it's rallied big time this week. And, when I just last looked, it was tracking at almost $86. So, yeah, it's doing really well. So the big bump this week came after a massive $11.5 million barrel drawdown in the U.S. inventories. We've also got gasoline demand in the U.S. It's still very strong at over 9 million barrels per day this week. In fact, like inventories of oil, gasoline, and diesel, they're all at either at or near the bottom of the 5-year average range. So you've got really low inventories. Demand is still doing very well. Also we've got the bullish side. We've got the Saudi Arabia production decline, and they plus potentially Russia are expected to extend those cuts right into the end of October. So with oil, if it holds above $85, our models project that we will see probably $93 to $94 oil soon. On the bearish side, we have that weak economy in China. We've got a recession in Germany, Sweden, much of the Eurozone, and potentially Japan. So, again, we look at these resistance and support levels, and if they break, then we watch the trends changing. Right now, oil's in an uptrend. Near-term support for oil, 79.70, then 76, then 74. Near-term resistance at 85, which it's already gone through, so hopefully it holds there. Then 88.50, 92.75. If oil can break through 88.50 and hold above that level, I can see this rally extending into October. Now, long term, if we look on the demand side, you've got India and all these emerging countries. They're expanding, they're growing. They need power, so they're going to ramp up demand. Also, China's been having all kinds of problems economically. I'm expecting there's going to be a big stimulus package going in there, and that's going to boost oil demand. And then on the supply side, we've got the same story here. We've got the lack of investment. We report each week, rig counts are just dropping, week after week after week. And then you get, capital expenditure in the oil sector down to 35 to 40-year lows. And the reason for those is that governments have a global hate-on for fossil fuels. So they've increased the windfall taxes. They've increased the regulations. They're allowing no new permitting. So, you combine all that, Jim, that just creates a huge supply problem for the next few years. So we expect to see $100 oil, likely $150, even higher in the next 1 to 3 years.
Martin, anything else that we should be keeping a real close eye on right now that maybe we didn't bring up?
One of the sectors, like I say, we're bullish the various sectors. You got uranium booming. You've got, materials doing well. Even cannabis last month had the health department. So, the big thing to me is September is historically a weak month. You've got all the big Wall Street guys who'll be coming back after their summer vacation. So I think we're going to see some activity, and we'll probably see in that first week, we'll get a pretty good hint at, where they see the market going. And like I say, and what we do is we just watch the trends, and we'll just react accordingly. So, yeah, it's going to be a very interesting fall here, Jim. So, Now, the other thing, just real quickly, I think we did this last time, and we're trying to help out the Special Olympics too. So what we're doing is we're going to offer your listeners 40 to 65% off, depending whether it's a single subscription or a combination. They can go to the trendletter.com/special-offer. And they can also just contact us at info@thetrendletter.com, and we will donate $100 for any new subscription to the Special Olympics.
Martin, thank you so much for being on This Week in Money.
Hey, my pleasure, Jim. Hope you and your listeners have a great weekend.
My guest has been Martin Straith, founder of Trend News online at thetrendletter.com. He was speaking to us from Coquitlam, British Columbia. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, Mark Leibovit, and Martin Straith. And thank you for listening. If you have any questions for the show or for our guests, you can send them to info@housestreet.com. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at talkdigitalnetwork.com. This Week in Money is a production of House Street Media Incorporated. Executive producer is Tom Allen.